All right, picture this. You're richer on paper than you've ever been in your life, yet you feel more uncertainty than you've ever felt in your life. What am I talking about? Well, that's the feeling when you either get a lot of money from a contract or in this scenario, you sold your business. Hey everyone, if we haven't met before, my name is Jacob Turner. I'm a former Major League Baseball player and I'm currently the co-founder of Moment Private Wealth. In today's video, we're going to dive into a topic that we see quite often in our business. An entrepreneur looking to sell and asking the question of, well, what can I spend? You see, there's a ton of nuance when it comes to this question because on the surface, it can be kind of simple. You can put it into some sort of investment calculator, go online and say, oh, well, I guess I could take 3% or 4% off my portfolio and spend that forever. But here's the reality of that situation. You need to think about planning. You need to think about taxes. You need to think about how you're going to invest the money. And you need to have confidence that you can actually spend the amount of money you want to spend. Oh, and guess what? You're not going to spend the same amount of money every single year for the rest of your life. So don't even think you are. Today in this video, what I'm going to do is I'm going to give you confidence. If you are an entrepreneur, if you're a business owner, and you're potentially looking at selling your business in the future, this is the video for you. Because at the end of this video, you're going to have a really clear sense of, if I sell my business, whether it's for $10 million like the scenario I'm talking about, $100 million or $1 million, you're going to have a really good idea of what you should be thinking about when it comes to taxes, planning, investments, to give you the confidence to know, what could I spend? All right, let's set the stage for our scenario today. So we're going to be talking about Jeff and Carrie. Now, these are hypothetical names. We've changed some of the numbers, but this is a real life scenario that we see time and time again in our business. And the scenario for Jeff looks like this. He owns a marketing company. He's been doing this marketing thing for a really long time. And he's finally gotten to the point where, one, he feels like he's a little bit burnt out. He's ready to move on to something else. But two, an offer came to him that he felt like he just couldn't pass up. So he got an offer on the table to sell his business for $10 million. And he wants to understand, if I sell my business for $10 million, what does that look like in the future? So we're going to walk through where Jeff is at from a financial perspective today, what it looks like from a tax perspective if he sells for $10 million, how that integrates with his current investment portfolio, and then ultimately at the end, we're going to talk about exactly what he could spend. So let's dive in. So oftentimes, one of the biggest mistakes I see people make is at the very beginning, they think, okay, I need to think about the tax consequences. And while that is true, instead of thinking about the tax consequences first, we need to back up. We need to think about the planning first, because think about it like this. We have to understand where we're starting at. We need to know where we want to go. And then we can look at all the variables in the middle in terms of how we're actually going to get there. So for Jeff and Carrie, let's take a look at their starting situation. So they have a total net worth of $3.2 million. Now look, this includes their primary residence and also their investment accounts. This does not include the business. So what you can see here is they have a family home that's worth about $1.5 million. They have investments that are worth about $1.5 million. So this is a revocable trust or a taxable account that has $500,000 in it. And they have a 401k that has $1 million. Now, this is a pretty common scenario that we see for business owners at this level of net worth. A $10 million business and a little bit of money outside of it. But the large majority of Jeff and Carrie's net worth is tied up in Jeff's business that he's been building for the last 20 years. And then they have about $250,000 in a bank account. Now, some might say that's a little bit high, but again, for a lot of the entrepreneurs we work with, they're keeping additional cash on the sidelines because there is so much volatility to their business. So this is our base starting point. The next thing that we always want to look at is we want to look at our goals. So what are the goals for Jeff and Carrie? We like to keep this really simple at the beginning. And then once we make a determination on how much we can spend and what taxes are going to look like and what the investment's going to look like, we can really further start to break down what the spending is going to look like. But from a base case scenario, Jeff and Carrie say, we want to live the same lifestyle that we've been living. They've been spending about $25,000 per month, and they want to be able to keep doing that and make sure that they could keep doing that when they sell the business. So that's what we have in here. We have a retirement expense starting next year of $25,000 per month. The next thing that I want to look at is income. So a couple of mistakes I see people make with income is, one, they don't count Social Security. We are going to count that. Two, they don't think of any income that they could earn after potentially selling their business in this situation. Let's walk through the situation for Jeff and Carrie. We have both of them receiving Social Security in the future. We have Jeff's salary here as $100,000. Now, what's important to note here is this salary is actually a 5-year earnout that Jeff's going to get. Now, remember, he owns a marketing company that's a service-based business. A lot of those businesses are going to have earnouts. So what we're looking at here is Jeff's going to earn a $100,000 salary essentially as a consultant for 5 years to stay on. They want to make sure that they're going to be able to use his expertise and his relationship to keep the business going. So you can see this starts at quote unquote Jeff's retirement next year after the business is sold and goes on for 5 years. The next thing that we're looking at here is the business sale. So we said at the beginning of this video, he's going to sell the business for $10 million. But the reason why we're breaking this apart is the business sale that's actually going to be taxed is going to be $8 million, which is what you're looking at here. Now, one thing that's really important to know on taxes, and we're going to talk in depth here in a second about this, is Jeff's business is structured and the business sale is going to be structured in a way that's all going to be capital gains taxes. So this is a really important note here that from a tax perspective, this is capital gains taxes, which is a significantly lower tax bill than if this was ordinary income. So we have $8 million that's actually going to be taxed at long-term capital gains rates. The next part of income that we have in here is Jeff's salary. This is the salary he's actually earning from the business today. So this is only going to go on for 1 year. So if we take a look at this salary, you can see it has $300,000. It started today. Is it going to end in retirement? In this plan, this salary is only going to go on for 1 year. And then the last piece of income on here we have is $2 million. Remember, we said it was a $10 million business sale. We already talked about how the $8 million is going to be taxed as long-term capital gains. Well, the other $2 million is going to be cost basis. This is money that Jeff has kept inside of his business. He's an S corporation. It's been passing through to him on his tax bill, but he's decided to keep this additional money in his business. This is money he's going to be able to pull out free and clear. He's already paid taxes on it. We made sure we put this down here in terms of this is a separate entity, separate line item in terms of this is tax-free money that's going to be coming to him. Of the $10 million, $8 million is going to be taxed at long-term capital gains rates. $2 million is going to be tax-free. The next thing we want to look at is additional savings. We're saying, hey, Jeff, we're going to shoot for trying to save $8 million. Again, this is base case. We haven't looked at taxes yet. Our goal is to save $8 million total. That's after taxes. And then we have expenses. These are our current expenses. Our current expenses are $25,000 a month, which again, I want to note here, Jeff and Carrie's goal was to spend the exact same amount of money they were spending before the business sale after the business sale. Now remember, we always want to start with the planning first, and then the next thing that we want to talk about is taxes. So we're going to go a deep dive on what it looks like from a tax perspective. Now remember what I said. This is a $10 million business sale. $8 million is going to be taxed in that business sale. $2 million is not going to be taxed. It's all going to be taxed at long-term capital gains rates. But check out this. This is where I think most people miss. You see, here's what people miss when it comes to taxes is I mentioned that these are capital gains taxes, which yes, they are lower than ordinary income taxes, but they're often higher than what people think. And here's what I mean. The capital gains tax rate goes like this. You pay 15% on a certain amount of capital gains, but over a certain income level, but Jeff and Carrie are definitely going to be over that income level, you pay 20%. And then even above and beyond that, most of the high earners that we work with are going to pay an additional 3.8% of what's called net investment income tax. So that is an additional tax on top of your 20%. Plus, you are also going to pay capital gains tax on your state. So for Jeff and Carrie, they live in the state of Missouri. It's about 5% state income tax. So you're not going to pay 15. You're not going to pay 20%. You're actually going to end up paying closer to 29% on those taxes because you're going to pay 20% capital gains, 3.8% net income, and then also another 5% in state taxes. Well, let's take a look at how this breaks down for Jeff and Carrie. We have $300,000 of wages here at the top. And if we scroll down, we have $8 million of long-term capital gains. So remember, $2 million is coming out tax-free because that's our cost basis in our business. The other $8 million is going to be taxed. If we scroll all the way down here, we made this really simple. We just took the standard deduction. In a normal planning scenario in terms of trying to optimize for taxes, we are going to be really focusing on the itemized deductions. This is a great year to do things like a donor advised fund, give away additional money. There's also key structures to how you actually structure the sale of the business. That's for another video, not for this one though. So if we take a look at our total taxable income is $8,270,000. That means our total tax bill is going to be about $1.968 million. Now, one thing I'll note on this is just our federal tax liability. This is not showing any state tax liability. So you can see here, we're paying about a marginal rate of 28%, but our effective rate's 23.8. Now, why is our effective rate 23.8? That's because most of this, outside of the $300,000, is all going to be capital gains income. That's 20% plus our 3.8% net investment income tax, which gets us to 23.8%. Again, this is just our federal tax liability. So now we're going to go back to our planning and say, okay, if this is what we're going to pay in taxes. Remember, we want to save $8 million. Can we actually save $8 million after taxes? Because remember, we still have to factor in our state taxes. Now that we understand the base planning, we understand what the taxes look like, let's see how all these variables potentially fit into the plan. And one of the first things that I like to look at is just the cash flows page. And what you guys are looking at here is this is what we call our summary page. So you can see here, year 2024, we have our $300,000. This is the income that Jeff is earning from actually working in the business. We have our expenses of $300,000, which is what he's spending on a yearly basis. And then in 2025 is when the business sale hits. He's going to get the $10 million business sale. You can see his expenses go up a little bit. This is adjusted for inflation. You can see his tax payment's $2.1 million. And what I think is really important to note here is if we take a little deeper dive into the tax payment, remember how we talked about those capital gains being a little bit higher than what people think. Well, in this calculation, we have about the same number on a federal tax basis, but we also have an additional $367,000 tax payment on the state basis. So you can see our overall tax estimate is about 2.1 million, as opposed to if we took a look at our deeper dive on taxes, we were at about 1.8. Remember, that was because we just had federal baked in. We hadn't looked at the state yet. This is a really important thing to look at. The rest of the summary page we can look at. The other big thing I wanted to look at here was our goal was to save $8 million. You can see right here, we're going to have net flows of about $7.6 million. So we were shooting for $8 million saved. We're still going to get really close to that. We're going to be able to save about $7.6 million. And then you can see on down, this is where Jeff's consulting income is going to come in. He's going to make $100,000 in 2025, 26, 27, 28, and 29. And then he's going to be fully retired after that. And you can see from there on out, you can see what the expenses look like. He's going to be spending $25,000 a month or $300,000 a year. This is inflation adjusted. So you can see with each year, he's progressively spending more money. So let's take a look at, does this plan actually work in reality? And we want to see how all this ties together. And what we're looking at here is what's called a Monte Carlo analysis. This is where we run thousands of different simulations. And what we're trying to predict is we're trying to say, in the future, we know one thing. We don't know what's going to happen. But if we don't know what's going to happen, how do we plan for it today? We run multiple simulations to say, where do we think this is going to go? So what you're looking at here is this 73% quote unquote probability of success, which is a word I don't really love. Probability of success means that 73% of the time, we're not going to have to change flight. Now, if you guys have been with me before, you know the analogy I like to use on this. Think about an airplane taking off. If we're in an airplane and we're taking off, that means 73% of the time, we can keep doing what we're doing. We can essentially put the plane on autopilot, make sure we're continuing to navigate forward, but we don't have to make any drastic changes. The other 27% of the time, it doesn't mean the plane's crashing. What it means is that we need to change course. We need to make tweaks or adjustments along the way. Now, this is a base case, but here, let's talk about levers that we could pull if we were Jeff and Carrie to either get this number to be higher or potentially get this number to be a little bit lower and be a little bit more aggressive with our spending. The first one, and probably the most obvious one, is we could spend less money. So if we look here, if we had $25,000 of spending, if we bump this down to $20,000 of spending, let's take a look at what that would give us. You can see our probability of success, or the chances of us changing course mid-flight, go from 27% only down to 10%. 90% of the time, we can just continue on with the plan. So that'll be a pretty good outcome. That's one option for Jeff and Carrie, but I'm really comfortable with that 73% number. So let's bump us back up to 25,000. And let's talk about one other thing that we can do to potentially make an adjustment here. The other big thing here is this retirement spending down here. You can see we have it listed as inflation adjusted. Now, this is a pretty standard way to do this. This means that every single year we're going to spend more money. But here's the reality. We don't spend more money every single year. Oftentimes we have these go-go years, and then we have these years where we don't spend as much. Or if the economy is doing really well, we might feel comfortable spending more. And if the economy is not doing well, we might feel like we need to tighten our belt a little bit. So what I like to look at is two different scenarios. The one that I like to use the most, and the one that we use with clients, is guardrails. This means that in really good years of the market, we can potentially spend more, but in really bad years, maybe we tighten the belt a little bit. Now, this doesn't mean we just pull everything off the table and stop spending altogether, but it does mean that we are conscious of what the economy is doing, where the market's at. So let's take a look at how this changes our plan of action. If we switch to a guardrails-based strategy from an inflation-adjusted strategy, you can see we go from a 73% probability of success all the way up to an 87% probability of success. Not only that, we're still spending that same $25,000 monthly amount. We haven't gone down in spending. We've just changed our strategy along the way. Again, use our airplane analogy. We've just changed our pre-flight course to say that, hey, when we know we hit these bumps in the road, we already know what we're going to do. And that's how I like to give clients confidence. Because again, remember what I said at the beginning of this video. The goal of this money is that you have confidence knowing what you can spend. Here's the reality for Jeff and Carrie. Their goal was to sell the business and be able to spend the same amount of money, $25,000 a month, before the sale that they can after the sale. And they can do that with ease. The number that we just showed was 87% probability of success, and that's with guardrails, which is what we use for our clients internally. And the other thing I want you to think about here is we could actually get a little bit more aggressive with this plan. If we bumped us up to $27,000 or $30,000 a month in spending, this is still a reasonable amount of money. Because the one thing that I see time and time again is they don't spend the same amount in the first couple of years as they do on the back half of their life. And what I mean by that is for Jeff and Carrie, they're 54 years old, they're in really good health, Most likely for the next 20 years, they're going to be able to really be able to use the resources they have. But chances are after those 20 years, they're probably going to be spending a little bit less money. And our goal as their advisor is to give them confidence to spend the most money that they can. Because the goal isn't to die with zero, but the goal is to make sure that we're using our resources when we're still alive. Again, guys, when we look at this scenario, I said at the beginning, I would tell you what you could spend. Well, you could easily spend 25. I think we could actually bump this up to 30. But the reality is that's going to change from year to year. Depending on what happens in the market, how the investments return, et cetera, we're always going to be monitoring this. And this is where I think working with a qualified team gives you confidence. I know for me, it gave me a ton of confidence when I was playing baseball to say, if things change, which they inevitably will, remember we talked about at the beginning of this video, the only sure thing we know is that whatever we plan for probably isn't going to happen. But we can run all these different scenarios. We can backtrack and say every single year, if we said that last year, what does it look like this year? And that's the goal. We want to give you confidence with your money. If you enjoyed this video, make sure you like and subscribe, and I look forward to seeing you on future videos. My goal with this channel is simple. It's to help you get smarter with your money.